How old were you when you began your investing journey? Turn on your TV or open social media and you'll see another young person suddenly becoming rich overnight from all different ways. Whether it's cryptocurrency, NFTs or dropshipping, this can lead to thoughts of what was I doing when I was that age, or what have I been doing wrong? Seeing these young people gain a massive fortune in such a short period, or even beginning their journey earlier than what you might have, is only natural. People are beginning their investment journeys earlier than ever, whether it's investing in online currencies or assets, or investing in themselves and starting their own business. The pandemic has introduced a completely new wave of investors, and has helped young investors begin their journey even earlier than usual. Lockdowns worldwide encouraged our everyday citizens to take the chance to possibly make a quick dollar, or even attempt to outsmart the market or your neighbor by finding the next big thing before others. According to Bank of America, more money was invested during the 5-month period of December 2020 to April 2021 than in the previous 12 years combined. Over $500 billion had flowed into equity funds. A CNB survey found that almost a third of investors who received government stimulus money during the pandemic invested some of it. However, younger and newer investors were more likely to put their stimulus money into assets. Of those aged 18 to 34 years old, 49% did so. 15% invested in individual stocks, 11% purchased cryptocurrencies, 9% invested in the mutual funds, and 8% bought exchange-traded funds. Young Australians are one group that has seen possible financial benefit over this lockdown pandemic. 78% of young Australians saw an increase in savings during 2020. 53% of young Australians had a sense of financial regret in 2020, primarily coming from not investing in the share market, spending too much online, or not saving. With 40% of young Australians saying they were first-time investors in 2020. You might be wondering what's so good about starting your investment journey as early as possible, and why you might have heard advice from your local friend, financial advisor, or online guru that says there's no better time than now. The famous quote of time in the market, not timing the market, or time in the market beats timing the market. Variations of this quote all tell the same story.
So there's a few reasons why timing the market usually doesn't work out over the long haul for investors, even if they manage to get a little bit ahead initially. First, there's the emotional factor. The market can be pretty volatile, as we just discussed, and it's very tough to see your investments fall by 10 or 20% over the span of a few days, weeks, or months, without taking some sort of action to try and stop the bleeding, as it were. Historically, at least when it comes to things like broad-based market index funds, this has led to a lower long-term return for investors who take action and sell during those situations. But despite knowing that, it's still a mistake that many investors, inexperienced and experienced alike, make every single day. Another reason is that since the markets are so volatile over the short term, it's incredibly easy to miss a really good day that comes out of nowhere, and that can have a surprisingly large effect on your overall returns and the size of your nest egg over time.
The longer you allow your investment to sit and allow compound interest to do its work. Compound interest, simply put, is earning interest on interest. The legendary investor Warren Buffett once called it the 8th wonder of the world. If you were to deposit $1,000 into a savings account that pays 2% interest, that means after a year, your balance will grow to $1,020 without adding any money. If you kept that money where it is, you'll continue earning interest on not just the initial $1,000 you put in, but also the $20. Assuming your interest rate stays the same, you'll earn $20.40 in interest in your second year of having that money in the account, for a balance of $1,040.40. Now after 40 years, that same $1,000 you invested at 2% will be worth $2,208.04, more than double your initial savings with no extra investment or work. This is where compound interest and starting your investment journey as early as possible is proved crucial. Instead of putting your 2% in a savings account, let's put that same amount of money, $1,000, into a proven successful ETF such as SPY. SPY is a S&P 500 ETF trust that offers an average 9.2% return annually. Instead of turning your $1,000 into $2,208.04, you can turn that $1,000 into $33,799 over that same time period. Now let's say, instead of 40 years, you started your journey 10 years later and leave that $1,000 for 30 years. Instead of getting $33,799, you will end up with $14,018, a $19,781 difference, with no extra work or money invested, just beginning your investment 10 years earlier. You might be wondering, other than compound interest, what other benefits are there to beginning your investment journey earlier? And the truth is, there are many. As a young person, you can take more risks. Taking risks and making errors and failures will happen with investing. Whether it's investing in a company you believe in would be the next big thing, or losing your savings in a meme coin. Investing is like anything. You will experience some growth pains and will hopefully learn from your failures and know what you did and where to make your next investment decision. No matter who you speak to, if a person has been an investor for a long period of time, they will all have a story of an investment they wish they hadn't made or an opportunity they missed out on. Nowadays, investing has been made easier and easier for young people, as they can now use online brokers and find out information on companies and markets with a few easy Google searches. They can see a company's financials or read about what their favorite investor is doing or what they have in their own portfolio. This tech wave, however, does come with its positive and negatives. The term pump and dump has been making headlines as influencers with no financial background all of a sudden have become advisors as they drive the prices of random stocks, cryptocurrencies and NFTs to the moon before dumping them, leaving clueless investors stranded with their own hard-earned money gone in the span of even a couple minutes.
Chat, by the way, that MILF token shit I did a while back, I already told you guys, don't buy that shit. I got paid a bag to do that. Like, I don't give a f***. I hope none of you guys actually bought it.
But with all the benefits of investing early, you have to think about the negatives that might come with it. The saying is, if it's too good to be true, then it probably is. The negatives of investing at a young age is the risk of loss. When young, you usually make less money and are subject to a lower wage. This is why researching and understanding what you are investing in is so crucial. Young people are more educated with technology, meaning doing a thorough research and reading what insightful, non-biased educational content is a must for all young investors. Starting your investment journey early is one of the best things you can do for yourself. It might seem like a waste, with your future being uncertain, but believe me, future you will be grateful you did this. You don't have to put away large sums of money every single day. A simple $200 a month for a long period of time can do the job and help you reach the cliche term of financial freedom. Subscribe, like and share this video, as it is all appreciated and goes a long way to support the channel.